So in this chapter, chapter 17, which is annual cost, earnings, and profitability analysis, the students will be covered five of the objectives in this chapter, which is the first objective is to estimate the annual cost using a standard cost sheet, and then student will be able to estimate the annual cash flows and working capital to complete the total capital investment, which is CTCI. Second one is student will be able to calculate the approximate profitability measures such as ROI, payback period, and venture profit and annualized cost. The next is students will be able to compute the present worth, future worth, and capitalized cost. And then students will be able to compute the cash flows and depreciation, and then use them for the NPV and IRR. And the last one is students will be use the expense process economic analyzer and economic spreadsheet to perform a profitability analysis for a potential process. So first thing first, before the students estimating the annual cost, the students should be estimate the sale revenue first before continue to decide either the process design can be proceed or not. So during the preliminary process synthesis, the calculation of the sale revenue can be determined either positive or negative value, so that it can be decided either process design can be proceed or not. Then the sale revenue also need to recalculate when the conversions and yields are better established. So example of the calculation for sales revenue is unit selling price times with the quantity of products produced for sale. The quantity depends on the material balance and annual operating cost. And on the other hand, the other possible credits can be affected by the effluents used as fuel, steam produced from boiler feed water, and the electricity from a gas expander.
Next, feedstock. Feedstocks are raw materials directly used to produce the final product and are consumed during the process. Its cost is a major component of the annual production cost in the cost sheet. So, to calculate annual feedstock cost, flow rate multiplied by operation hours multiplied by unit price. So, for example, 1000 kg per hour of raw materials multiplied by 8000 hour per year multiplied by 5 ringgit per kg. Feedstock cost increases with production capacity and is typically the largest contributor to total production costs. Next is utilities. Utilities are essential services that support plant operation but do not become part of the final product. While utilities cost represents the energy and the service requirements within the annual production cost. The example of utilities are electricity, steam, cooling water, and compressed air. So in order to calculate utility cost, we have to multiply consumption, operating hours, and unit cost. For example, 500 kilowatt multiplied by 8,000 hour per year multiplied by 40 cents per kilowatt per hour. So utility cost actually depends on the process conditions such as temperature, pressure, and energy demand.
Next, I will talk about the labor-related operation. Direct wages and benefit are a major component of annual operating costs in chemical plant. There are three types of estimation for the number of plant operator. The first one is type and arrangement of equipment. The second one is the number of process unit or sector. The last one is amount of instrument and the control for the process. Next, I will talk about the maintenance. Maintenance is referred to the annual cost required to keep plant equipment in safe and efficient working condition. There are two key points for maintenance. The first one is total depreciable capital (CTDC), and the second one is maintenance wages and benefit (MWMB). For example, the CTDC for fleet is 3.5% of MWMB, solid is 5%, and the solid mixed with fleet is 4.5%. Additional maintenance cost for engineer and supervisor is 25% of NWMB, material and service 100% of NWMB, and the maintenance overhead is 5% MWMB. The total maintenance cost is equal to MWMB plus engineer or supervisor plus materials or service plus overhead. So the equation is M equal to 2.3 multiplied with MWMB. For the fleet, maintenance is 8.05%, while the solid is 111.5%, and the mixed solid and fluid is 10.35%. There are some cost control tips for maintenance. The first one is use durable material. The second one is avoid high shaft speed. The third one is schedule preventive maintenance, clean HH tubing regularly, and perform during annual shutdown, 2.3 weeks. Next is operating overhead. Overhead includes indirect expenses not directly tied to the operation such as safety, administration, employee service, and facilities. It estimates as a fraction of combined labor and maintenance costs. For example, the total annual operating overhead is about 22.8% is equal to sum of general plant overhead, mechanical department service, employee relation department, and also business service. It ensuring the smooth and supportive plant operation.
Next, we move on to property taxes and insurance. So these costs are assessed by the local municipality, not by federal tax authorities. So they are calculated based on the total depreciable capital, CTDC, which represents the planned investment value. So typically, property taxes range from 1% in rural areas and up to 3% in urban areas. For insurance, the cost depends on how risky the plant operation is. For example, if the plant handles flammable, explosive, or toxic materials, the insurance will be higher. Usually, insurance is estimated around 0.5% to 1.5% of CTDC. But if we don't have the detailed data, we can assume a simple estimated where property tax plus insurance equals about 2% of CTDC, as given in table 17.1. Next is depreciation. Depreciation represents the decrease in asset value over time. So in plant economics, we use it to allocate the capital cost over the plant lifetime and to estimate the profitability. So a common method is straight line depreciation, where the same amount is deducted every year. So typical assumptions used include around 8% depreciation for direct plant costs and around 6% allocated for off-site costs and a plant lifetime for about 10 to 12 years. So here the important point is that higher depreciation reduces taxable income, which can actually increase the net profit after tax. Now we move to rental fees. So this usually apply during the early stage of a startup company before having a full plant setup. Rental fees covers office space and laboratory facilities, and the cost itself depends on the quality and cleanliness of the facilities. So this is more relevant during initial operation phases rather than full-scale production. Next, licensing fees, which are required when a company uses a patented processes or products. So the cost mainly depends on the product sales and value and how unique the process is. Typically, licensing fees range from 1% to 5% of product sales. But if there's no data is available, we assume an initial royalty of about 2% of CTDC and annual licensing of about 3% of the product sales. Next, the cost of manufacture, or COM. So this represents the total cost required to produce the product, and it consists of three main components, which are direct manufacturing costs, operating overhead, and also fixed costs. So the equation is COM equals direct manufacturing cost plus operating overhead plus fixed costs. So you can refer to table 17.1 for detailed breakdowns. After calculating COM, we can determine the total production cost, C. So this is given by C equals COM plus general expenses. And general expenses are costs that are not directly tied to production and are usually managed at corporate level. So general expenses include several categories, which are the first, selling and travel expenses such as office costs, advertising, and also shipping. Second, research expenses, which can be both direct and allocated. And third, administrative expenses, which include top management and general administrative activities. And finally, management incentive compensation. Typically, total general expenses are around 9.55% to 11.55% of sales. And next, we move to the profit calculation. The gross earnings or pre-tax profit are calculated as sales minus total production cost, so S minus C. Then we get to the net profit. We consider taxes. Net profit is calculated as 1 minus tax rate times gross earnings. For example, if the tax rate is 40%, then net profit equals to 0.6 times S minus C. So this shows how taxes directly reduce the final profit.
Now, I will explain about working capital and total capital investment. Working capital refers to the fund required to support the day-to-day operation of a plant. This includes expenses such as maintaining inventories of raw materials and finished products, as well as managing accounts receivable from customers. In practice, working capital is commonly estimated as approximately 10 to 20% of the total capital investment. The exact value depends on factors such as production cycle time, inventory requirements, and credit policies. Next, total capital investment or TCI is defined as the sum of fixed capital investment and working capital. In other words, it represents the total amount of money required to start and operate a project. Working capital is particularly important because it ensures continuous operation before revenue is fully generated. At the end of the project life, it is usually recovered.
So the topic we covered here is section 17.4, the approximate profitability measures. There are a number of profitability measures, about 3 to 4, including the ROI, payback period, venture profit, and annualized costs. They're used to estimate the capital investment and annual earnings. All the approximate measures are listed in table 17.5 over here. So the first one, ROI, is defined as the annual interest rate made by the profits on the original investment. Payback period is the time required for annual earnings must be equal to the original investment. Annual net earnings in excess of a minimum acceptable ROI, I minimum equals to 0.2 or 20% is definition for the venture profit. And last but not least, annualized cost is the sum of production cost and reasonable return on the original investment, where I minimum is taken here as 0.2, same as the venture profit. Now let's take a look at the example 17.14. In this example, you'll learn how to apply the formula of ROI and payback period in this scenario-based question. First of all, you need to know the difference between ROI and payback period. For payback period, the annual depreciation, D, will be added back to the net earnings as D will be retained by the company at the end. From this question, we know that the total depreciable capital is given, which is 90 million. The S, sales revenue, is 150 million per year. Although the C, annual production cost, is not given directly, but we know that 100 million per year plus the depreciation value will get the value of C. And after that, we just have to substitute all the value into the formula, and then we'll get our I equals to 19.8%. For the payback period, is the same as our I. Just have to substitute in the value, and then we'll get the value equals to 2 point something years. Now let's take a look at the example 2. In this example, you'll learn how to calculate the venture profit. So as you can see here, the net earnings is already given, which is 1.05 million. And I minimum will assume it to be 20%, which is 0.2. And the CTCI, total capital investment, will be equals to 4.816 million. And just substitute in, you'll get the venture profit equals to 87200 per year. Now we are in the last part of section 17.4. When a new chemical is established, rather than guessing the price, there are two methods we can use to estimate the selling price. The first method is to assume a desirable ROI, let's say 20%, and use equation 17.7 to calculate the selling price necessary to achieve this objective. While method 2 is to set the venture point to 0 and use equation 17.9 to calculate the minimum selling price. As you can see here, equation 17.7 and 17.9 is already given shown in the bottom corner of the slide. And let's look at the example 17.17. As you can see here, the C, which is the annual production cost, is already given, which is 28.257 million per year. And we just have to substitute all the value into the formula of ROI by estimating the ROI is equals to 20%. And while the S revenue, the sales revenue, is 44.131 million, X is the unknown value we are going to find. And after that, we get the value of X equals to 0.67 per pound, which is slightly lower than the 0.68 per pound. So to achieve a higher ROI, the selling price need to be increased. While the second one, we set the venture point to 0. And after substitute in all the value, we'll get the same value as the method 1.
So now I'm going to explain about the time value of money. 1,000 ringgit now is not the same as 1,000 ringgit 5 years later. Why? Because inflation reduces purchasing power. There's also an opportunity cost that you incur because you could have invested that 1,000 ringgit, as well as the risk over time. To calculate the time value of money, we use the formula for compound interest. F equals P bracketed 1 plus I to the power of n, where P is your present value, F is your future value, I is your interest rate, and n is the number of periods. However, when interest is compounded at a different frequency than the stated period, for example, at 4.5 interest per annum, but compounded every month, you have to use a different equation. In this case, you can see the interest variable is divided by the number of compounds per period, while the period variable is multiplied by the number of compounds per period. Therefore, the difference between nominal interest rate and effective interest rate is where the nominal is a stated value for this example, 12% interest per annum. However, when combined with a different compounding frequency, in this case the monthly compoundment, you get an effective rate of nearer to 13% rather than 12%. On the other hand, when the compounding frequency reaches near infinity, this is also known as continuous compounding. For continuous compounding, the equation is as follows, where f, your future value, is equal to present value multiplied by the Euler's number to the power of interest rate and the number of periods. As for a comparison between the nominal, effective, and continuous compoundment method, you can see that the larger your frequency of compoundment, the higher your value of your asset.
So next, we move to annuities present worth and comparing alternative equipment purchases. Annuities. So what does it mean by annuities? An annuities is like a financial subscription. Instead of dealing with one giant lump sum of money all at once, we are dealing with steady and repeating habit, like you pay by month and or quarterly. And here's are some calculation for the value money, annuity factor, and uniform series payment. These are some example. So next we move to discrete compound. What is discrete compound? Is an ordinary annuity for future worth F by determined by more than just applying interest to a single enormous lump amount, and each payment has a different lifespan and earn a unique amount of interest since the interest is compounded discretely, and it also apply at the precise and end of the each period, and the single payment of a discrete which occurs step by step. So here's are the calculation that we use that include the future value, uniform payment, and interest rates, and n for n number of compounded. So next, we move to present worth of an annuities. What is present worth of an annuities? Present worth is required to lump sum investment. Today is perfectly fund or match for the future amount of an annuity. And here's are the key equation by sinking from a factor to calculate the payment A needed to build up for the future target. These are the equation that we use, and here for the single, then for the continuous, for uniform series, and capital recovery with payment at the end of each year is obtained. Here's are the calculation that we use that include the future value, uniform payment, R for release interest rate, and N for number of compounded, Y for end of the year that we want. An example for 20 year and above. So next we move to comparing the alternative equipment purchases. So the first of all, we move to level of equipment. After the main plan has been designed, you are purchasing the specific piece of equipment and the instrument. So the present was to determine how much money you must pay for one lump sum amount today to cover the purchases and all ongoing operating expense, and to consider also the capital lease cost, present value of variation apply to equipment with the endless lifespan. This emphasizes the entire of reducing the expenses by price and longevity as suppose increasing sale. Then we move to the plant level for major design and retrofit. When comparing completely different plant design while doing extensive retrofit, and we have the NPV, net present value, like Nicholas say, determine the project the current value after deducting expense, the percentage of yield or profit margin that the project will produce is determined by the rate of return IRR. So here's the comparison scale, this table, comparative scale, scenario, recommended, and primary focus. So first we could move to individual. So individual, comparing the item with the different cost lifespan after the main plan is designed and recommended to using the present work or capital cost for infinite lifespan. And for primary focus, we minimizing total life cycle, cost purchasing and maintenance. So for the whole plan and retrofit, we are comparing entirely alternatively plan design or major system overhaul. And we are recommended to use the net present value or rate of return, or we call IRR. And we focusing on profitability strictly account for incoming sale revenue. So for zero revenue system, we comparing an essential system to do not generate any sale. An example like wastewater treatment. So I recommended to use the present word and NPV because they are mathematically identical. So the primary focus is on the finding the cheapest overall cost over time.
For this section, we discuss the cash flow and depreciation. First, in the earlier stages, company often use simple methods like ROI and payback period to evaluate the project. This method is useful because they are quick and easy. However, they are not enough for making your final decisions. So that's why the cash flow analysis become important. What is cash flow? Cash flow is defined as the movement of the money into or out of the company. If the money comes into the company, it is a positive cash flow. If the money goes out, it is a negative cash flow. In the term of investments, the initial cost of investments is considered negative cash flow, while the after-tax profit plus depreciations is considered positive cash flow. During the construction phase, the cash flow is negative because the money is spent on the capital, the working capital, and land. The equation is using equation 17.38. Next, during the operation phase, we first calculate the profit. The gross profit is sale minus cost, and the net profit is after tax. Then the cash flow is calculated using these two equations, 17.4 and 17.5. Okay, next, depreciation is added because it is a non-cash expense, but it is still reduced take, so it is increased cash flow. For the complete cash flow equations, we also include the other factors such as the startup cost, royalty cost, additional investment, and also the salvage value at the end of the project. Working capital is usually recovered at the end, which gives the positive cash flow. Depreciation is the reductions in the value of assets over time. The company can treat depreciation as a cost which reduces income tax, even though no cash actually leaves the company. For simple profitability measure like ROI, the straight line method is usually used. This spread the cost evenly over the asset's life and give a snapshot of the project value often in the third year. Depreciations also affect a more accurate measure like NPV and IRR, which consider the time value of the money. It is advantageous for the company to depreciate more in the early year because the plants may operate below the capacity and discount factor are low. Common accelerate method include declining balance, double declining balance, sums of year digits, SCRAs and MSCRAs.
The company often use different methods for books and the tax. Book value is the original cost minus accumulated depreciations, and it is yearly until the salvage value is reached. The depreciation periods is based on the estimate useful life of the asset. The declining balance method, also called the fixed percentage method, calculate depreciations as a fixed fraction of the asset's book value each year. Here, the book value is the original cost minus accumulated depreciations. It is decreased every year, but it cannot drop below the salvage value. The annual depreciation is calculated as the book value at the start of the year multiplied by the fraction t. The fraction t is usually between 1 over n and 2 over n, where n is the numbers of years of useful life. Commonly, 1.5 over n is used for the 150% declining balance, and 2 over n is used for double declining balance. The double declining balance method is the type of accelerated depreciations where d is equal to 2 over n. This method depreciates more in the early years, which reduce the taxable income and increase cash flow early in the asset's life. Sometimes the declining balance methods alone cannot reach the salvage value exactly. To solve this, we use the combinations method, which switches to the straight line depreciation pathway through the asset life. Another way is back calculated d using equation 17.45. If the compute d is too high or greater than 0.2, we must use the combination method. Next, for the sum of the year's digits, or SYD method, is an accelerated depreciation method where more depreciation is taken in the early years and less in the later years. It is very useful because it can include a salvage value, even 0. However, its acceleration is not as fast as a double declining method. This method is based on the sums of the year's digit from 1 to n, which is calculated using the equation 17.46. For example, if the asset's life is 10 years, the total sum is 55. The annual depreciation is then calculated using the equation 17.47, where higher fractions are used in the early years. For the examples, in the year 1, the fractions is 10 over 55, which is higher than straight line depreciations. As the time increases, the fractions decrease, such as 5 over 55 in the year 6. Overall, SYD provide moderate acceleration, faster than straight line but slower than double decline balance. Both ACRAs and MACRAs are based on the decline balance method, with a switch to the straight line method when it provides a higher depreciation rate. This allows the companies to maximize the depreciation benefits over the time. These methods also assume that assets are placed in the service at the midpoint of the year. As a result, only 50% of the depreciation is applied in the first year. For the MSCRAs, there is additional features where depreciation continues for 1 year beyond the asset's useful life. In these final years, only 50% of the straight line depreciation is taken. The service life of assets, also known as a class life, is determined by regulatory guidelines and typically range from 3 to 15 years or longer. Two systems are available, which is the general depreciation system, which is commonly used due to its shorter class life, and the alternative depreciation system, which provides a longer recovery period. In the practice, depreciation value are obtained from MACRA's table, and the method usually begins with a double declining balance before switch to the straight line when depreciation. Depletions refer to the reductions of the natural resources as they are extracted or used. Unlike depreciation, which applies to the replaceable assets, depletions applies to resources that are not easily replaced, such as mineral, oil, gas, forest, fishery, and quarries. There are two main methods of calculating depletions. The first one is the cost or factor depletion. This method is based on the quantity of the resources removed each year using an initial estimate of recoverable resources and their cost. The annual depletion charge is calculated as the product of the cost factors and unit recovered. And total depletion cannot exceed the original cost of the resources. The second one is the percentage depletion. These methods allow a fixed percentage of the sale revenue from the resource to be deducted, subject to a limit of 50% of taxable income before depletion. Unlike cost depletion, total charge may exceed the original cost. For oil and gas, only small producers can use percentage depletions. When both methods are available, the larger annual depletion charge is applied. Overall, depletions ensure that the cost of using natural resources is reflected as an expense in financial and tax calculation. Let's we look at the example of depletions. The questions given that 900,000 tons of lead and zinc ore is purchased for $4,500,000. In the first year, 10,000 tons are mined and sold at $20 per ton. And then expense for the year are $1,200,000 and the tax rate is 40%. So for the A, we need to find the cost depletion. So first, we calculate the cost per ton, where $4,500,000 divided by 900,000 tons give $5 per ton. And then we find the depletion charge, profit before tax, and then we got the answers of $680,000. For B, percentage depletions from table 17.11, allowable depletions is 22% of sale revenue. So 0.22 times with 2 million, so the answer is $440,000, but it cannot exceed the 50% of the taxable income before depletions. Taxable income before depletions is equal to the sale of revenue minus expense, thus we get $800,000. So 50% of it is $400,000. Next, we calculate profit before tax, income tax, net profit. So the answer is the cash flow is equal to net profit plus depletion. So the answer is $640,000. So in the conclusion, in conclusions, cost depletion provide a slightly higher cash flow than the percentage depletion.
Moving on to the rigorous profitability measures, the two principal profitability measures that incorporate the time value of money using discounted cash flows are the net present value or NPV and the investor's rate of return or IRR, which is also referred to as the discounted cash flow rate of return. Unlike approximate methods, these measures evaluate a project based on cash flows over its entire lifetime, making them more accurate and suitable for final investment decisions. NPV is defined as the present value of all future cash flows minus the initial investment. Because money has time value, future cash flows are discounted to their present value using a chosen interest rate. This allows us to compare all cash flows on a consistent basis. If the NPV is greater than 0, the project is considered profitable and should be accepted. If it is less than 0, the project should be rejected. In simple terms, NPV tells us how much value the project adds today. The IRR is the discount rate at which the net present value becomes 0. This means it represents the actual rate of return generated by the project over its lifetime. We compare the IRR with the required rate of return. If the IRR is higher, the project is acceptable, and if it is lower, the project should be rejected. IRR is particularly useful because it expresses profitability as a percentage, making it easy to compare different projects. Moving on to inflation. Inflation refers to the increase in prices and costs over time, which reduces the purchasing power of money. In a project, both costs and revenues may change due to inflation. For example, raw material costs, labor, and product prices may all increase over time. There are two ways to handle this in economic analysis. Nominal values include inflation while real values exclude it. It is important to use a discount rate that is consistent with the type of cash flow being used. Inflation is important because ignoring it can lead to inaccurate predictions of profitability, such as overestimating profits or underestimating costs.
So next we move to profitable analysis spreadsheet. In this section, we will do all this calculation in the Excel. So what is the subtopic in the calculation in the Excel, which is we have input summary, profit measure, cost summary, variable cost and working capital, cash summary, total permanent invest, equipment cost, fixed cost, and so on. So we will know all this calculation in the Excel. So this example equation, the plant is located in Gulf Coast. The design time estimated to be first year, and also the project duration is 15 years. So during the first 3 years, the production rate increased to 90% from 50% to 100%. So in year 1 until 3, the production rate is 45%, 77.5, and also 90%, respectively. And it is assumed that all the equipment have been installed before we started the project, and the cost of capital is taken 50% annually. So let's get started to the calculation. So from the question, it is given for the variable cost and working capital, which is it is stated that general expense for selling, direct research, allocated research, administrative expensive, and also the working capital. They also stated that account receivable for 30 days, and as stated in this slide. Next, for input that have been given is the process title, where is the location, operating hours, operating factors. So we move to cost summary. Cost is basically what we have to spend on our project in order to increase or improve our business. So in these terms, they use the money to invest on fabricated equipment, process machinery, and this section they spend about 1,225,000. Then for direct permanent investment, they spend to cost of site preparation, cost of service facilities. So this budget they have spent around 123,000. Then for total depreciable capital, which is they have spent around 243,000. And last but not least, they have spent about total permanent investment of course, where is the location they want to rent, cost of land, royalty, startup of the plant, around total 191,600. And when we total up all of this budget, they will gonna spend about 1,788,000. So for the equipment cost, basically they have spent for distillation column, absorber, heat exchanger, flash vessel, and also pump. And they will get the total is 1,225,000 for profitable measure. IRR is 32.17, and for ROI analysis, annual sales is 27 million, annual cost is 24 million, depreciation is 1,027 for income tax is 115,000, net earnings is 1 million, and for total capital investment is 4 million, and also for the ROI is 34.75. So then for the selling price of the price they sell is about 0.8 dollar per pound. So they produce about 5,572 pound of MCB per hour, and then 133,000 per day. So for total permanent investment, cost of service facility around 5%, allocate cost for utility is 5%, cost of land 80%, cost of royalty is 2%. Then we move to a fixed cost, which is this cost is actually they have to pay on something. We move to one by one. Okay, so for the first thing is operation. So they have a direct wage of benefits and control laboratory assistance. So this section they have spent about 1 million. Then operating overhead, for general plant overhead, mechanical department service, employee relation, they have spent about 125,000. Then for maintenance of the plant is 128,000. Then we move to property tax and insurance. They have spent about 31,000, and then we total up and we will get the total of the fixed cost that they have spent on this fixed cost. After we get all the data and information regarding cost, investment, net capital, working, and so on, we have to input all the data into the Excel. Then it will generate the calculations.